Welcome students. We will discuss chapter 18, that is financial modeling and pro forma analysis. In this chapter we will see the long-term financial planning, like as I said, based on the actual financial statement analysis, how we can forecast for future, maybe 5 years forecasting. So how to make the long-term financial planning. The most popular one which we will include in this chapter is percentage of sales method. So in this, what we do, we will try to forecast the future sales, and based on the sales, all the other items, most of the items, we will create as a proportion of the sales. Let us see how we will do in this chapter. Then we forecast the planned expansion. Then we find out the growth for the farm, and then make the valuation of the company. Understand the goals of long-term financial planning. Create a pro forma income statement and pro forma balance sheet. Maybe if you are doing the actual financial statement for 16, then you can make the pro forma income statement for 17, 18, 19, 20, 21. Same like pro forma balance sheet for next 5 years. Develop financial model of the firm by directly forecasting capital expenditure, working capital needs, and financial events. Then what happens? We first forecast the sales. Then based on that, other items we will calculate. We will calculate the income statement. We will calculate the balance sheet. Then we will calculate the working capital requirement. Then the additional working capital needs we will calculate. After that, free cash flow can be easily calculated. Net income added with depreciation, deducted with additional working capital requirement, deducted with capital expenditure will be the free cash flow. Based on the free cash flow, you can comfortably make the valuation. Distinguish between the concepts of sustainable growth and value increasing growth. We will calculate the growth also in this chapter. Already we have calculated growth in chapter 2, that is equal to sustainable growth. You all remember sustainable growth rate is equal to ROE multiplied by RR, return on equity multiplied by retention rate. We will again do it here. The value increasing growth will be the internal growth rate, that will be the ROA multiplied by retention rate, return on asset multiplied by retention rate. Both we will see again here, and we will calculate the pro forma analysis. Let us start. For doing the financial forecasting, we will identify the important linkage like sales and the costs, capital investments, financing, that is the external financing requirement. We analyze the impact of potential business plans. What are the plans for future? And we will analyze plan for future funding needs, where from the extra money will come. The most important one, there are many other methods are there, but the most important one the industry make practice is the percentage of sales method. Here, a forecasting method that assumes that balance sheet and income statement items grow proportionately with the sales. Now, remember chapter 2. As I said you, it is an extension of chapter 2. So, we make a percentage of all the items as a percentage of the sales. For example, total cost percentage of sales, depreciation as a percentage of sales, the kind of selling general administrative expenses percentage of sales. In the balance sheet also we can make the percentage of sales like the current assets, the cash as percentage of sales, receivable percentage of sales, inventory percentage of sales, current assets percentage of sales, fixed assets percentage of sales, total asset percentage of sales. All items, almost all items, some items we will not, like the current liabilities, that is the bills accounts payable percentage of sales. But the long-term liability and the share capital, we will not make percentage of sales. They will be kept as constant. We will see how. In this question for 2016, the income statement and balance sheet for KMS design is provided to you. You see here, as I said you in the previous slide, sales percentage of sales is 100%. Cost except depreciation, 78% of the sales. EBITDA, 22% of the sales. Depreciation, 7.333% of sales. EBIT, 15% of sales. Interest expenses, not applicable here, not manageable here, or not measured here. Pre-tax income, 14% of the sales. Income tax, not measured here as percentage of sales. No, not measured. Certain items we don't measure. That is written in NM here. Indicates the item of percent not meaningful. And in net income, 9% of the sales. Cash and cash equivalent, 16% of sales. Receivables, 19% of sales. Inventories, 20% of the sales. Total current assets, 55% of the sales. Property plant, 66% of the sales. Total asset, 121% of the sales. So all the asset side we measured as a percentage of sales. Come to the liability side, payable, 16% of sales. Debt, as I told you in the previous slide, debt will not be, as it is we will keep. So not measured or not meaningful. Total liabilities, not measured or not meaningful. Stockholder equity, not meaningful. As I told you, stockholders equity and the long-term debt. We won't measure as a percentage of sales. Otherwise, almost all items we measure as a percentage of sales in the balance sheet. In the income statement, interest is not measured, income tax is not measured. All other items we measured as a percentage of sales. Then what will happen? Very simple. We have measured all the items as percentage of sales. Now come on, forecast the sales for 2017. So, for example, the growth is 18%. Again, of course, the growth is explained at last. Let me explain you here only. For example, the growth is calculated as 18%. How it come? ROE multiplied by RR. Many different methods are there. Some authors use directly ROE multiplied by RR. Some authors use ROE multiplied by RR divided by 1 minus ROE multiplied by RR. Similar answers will come, little difference will be there. We will use here ROE multiplied by RR. Return on equity multiplied by retention rate will give you growth. Say for example, growth is 18%. Some authors, some analysts, what they do? They see the past growth of the sales. For example, they see the growth of last 10 years sales growth. That also they can predict for next 5 years. So anyway, you got the growth here 18%. The company has predicted a growth of 18%. Then what will happen, dear students? Very simple. The 2016 sales, that is 74,889, will grow at 18%. After that, all other items, we know the percentage of sales. Come on, do it. Cost, 70% of the new sales. Depreciation, 7.333% of the sales. Tax, whatever taxable income will come. We have seen in the previous income statement, the taxable income is how much? Taxable income is 10,678. Tax is 3,737. So the tax rate will be 3,737 divided by 10,678 is equal to 35%. Do it now. Everything is available with us. Do it. 2016 sales is 74,889. It will grow at 18%. So 2017 sales will be predicted 74,889 multiplied by 1.18 is equal to 88,369. Minus cost. We have calculated cost is 78% of the sales. So 78% of 88,369 is 68,928. EBITDA 88,369 minus 68,928 is equal to 19,441. Depreciation 7.333% of 88,369. That is the new sales. 6480. EBIT 19,441 minus 6480 is equal to EBIT. Interest remains the same. You remember in the forecasting we have written not meaningful for interest. We will keep as it is because interest might not increase in the proportionate of the sales. It depends on the borrowing. Think there is no new borrowing, so interest will be 306 constant. Pre-tax income 12,655. Income tax 35% of 12,655, 4,429. Net income 8,226. See, and extend this for next 5 years. You will have forecasting for 18, 19, 20, 21, 22. So this is the way the forecasting income statement is done here. Now problem, it is some changes are being done here. KMS has just revised its sales forecast downward. We have taken 18% growth, right? Now KMS is downgrading its growth. It is now evaluating 10% as the growth. How you will do it? Very simple. 2016 sales multiplied by 1.10 is equal to 2017 sales. Then 78% of the sales will be the cost. All other items like 78% of the new sales will be the cost. 7.333% of the new sales will be the depreciation. Interest remains the same. Income tax will be 35% of the pre-tax income. Alright? So this is the way we make it. Now 18.1a, homework for you. Now the company is further downgrading the growth to 7%. You can do it. 2016 sales multiplied by 1.07. Now the new growth is 7%. So 1 plus 7% is equal to 1.07. New sales will come. Once you get the new sales, 78% of the new sales will be cost, 7.333% of the new sales will be the depreciation. Calculate. 35% of the pre-tax income is the tax. Interest remains the same. Do it. Then comes to the balance sheet. As we have seen, balance sheet, all asset side measured as a percentage of the sales, new sales. So we have calculated all the percentage of the sales here. Cash 16% of the new sales, receivable 19% of the new sales, inventory 20% of the new sales, total current asset 55% of the new sales, property plant 66% of the new sales, total asset 121% of the new sales. Do it. Cash 16% of the new sales, receivable 19% of the new sales. So all these assets are being interpreted. In the liability side, only accounts payable is 16% of the new sales. Debt we will keep as it is. As I said you, debt never changes along with the sales. So not meaningful to make as percentage of the sales. We will keep it constant. 2016 4,500. 2017 also will keep constant to 4,500. Total liability calculated. Stockholder equity, the original 2016 stockholder equity plus the 70% of the net income of 2017. 30% is paid as dividend. So the net income of 2017 forecasted 8,226. Out of 8,226, 30% is dividend. So 70% is retention. So that retained earning will be added back. So the new shareholder equity will be old stockholders equity plus 70% of the net income. Then we will get the total liabilities and equity. Now dear students, our balance sheet identity will not work here. In chapter 2 we have seen balance sheet identity. Assets must be equal to liabilities and capital. assets are 2017. These are the forecasting assets. These are not the actual you are forecasting. Your total assets is 106,927, but your liabilities are 98,531. So the difference between asset and liability is equal to 8396. That will be the new financing requirement. The new financing requirement for the company is 8,396 in 2017. I hope it is clear. Now question is how it will balance. We will 8,396 we have to create new financing either through the debt or through the equity or through the retained earning. Either of the three ways: retained earning, in the last chapter we have seen retained earning, debt or equity. Any of the method the company can raise the money. Retained earning already 70% is added here. You can see in the stockholder equity 70% is added. Remaining 30% which we are paying to the shareholder, without paying we can use it. Or we can say okay, 70% let it be like this. This 8,396 we will borrow from the bank at interest. Or we can issue bonds. That is called debt. Or the company can think for issuing equity. Either of the three ways, this 8,396 should be borrowed or raised from the market or used from the retained earning. So, first priority company has given for borrowing. Think the company has borrowed 8,000. Carefully listen please. The new financing required is how much? 8,396. Where from it came? Total assets are 106,927. Line number 9. Total liabilities and equity are 98,531. Line number 15. So there is a mismatch. Assets, how you will buy 106,927 asset? You have only 98,531 in your company. So you have to borrow 8,396. The company has borrowed 8,396. Then how the balance sheet will look like? Asset side as it is 106,927. The debt will be now old debt 4,500. We kept it as it is. That 4,500 in line number 12, 4,500, we will not keep it same. We will add the new borrowing here. The 8,396 we will borrow as a debt. Then our new debt will be how much? 4,500 plus 8,396 is equal to 12,896. Now you see asset side is equal to liability side and equity side. Asset side must be same with the liability and equity as per the balance sheet identity. Therefore, asset side here is 106,927. After the new borrowing, it became 106,927 liability and equity. Now, 2017 forecasting got over. This is the simple sales forecast method. If, for example, instead of, as I said you, this 8,396 which is borrowed here, the company might think for using the retained earning. Then what will happen? Company already keeping 70% retained earning. You can see here. The company is already using 70% of retained earning. 70% of 8,226 the company already using. 30% paying dividend. That also the company can use in the company. Without paying dividend, the company might use it as retained earning. Then what will happen? The 30% of 8,226 will be, instead of now the company is holding 70% of 8226. 70% of 8226 is 5758. Instead of keeping 5758, the company can keep whole the net income 8,226 without paying the 30% dividend. All the amount of net income the company can use for the growth. Then what will happen? The additional 2468, 8,226 is the net income. 5758 already the company hold in the company without paying dividend. What is the dividend the company pays? 2468. The company pays a dividend of 2468. All right. 30% of 8,226 is 2,468. This is the dividend the company pays. Now the company needs money and it has to borrow. The company management decided we will not borrow from market. We will, whatever dividend we are paying, that also we will use in the business. Then how much is the dividend paid? 2468. Let us keep in the business. So 2017, the stockholder equity will be 79,892. Previously we calculated 79,892. That will be added with the dividends 2468. So the new equity will be 82,360. And the total will look like 100,999. How this 100,999 came? 98,531. You can see here 98,531 is the line number 15. The 98,531 added with, open your calculators please, 98, just if you have your calculator in your hand you can easily do it, or open your spreadsheet. 98,531, 98,531, when you are holding 70% of the net income, your total liability and equity will be 98,531. Now the company wants 100% to retain. Then this 98,531 will be added with 2,468. That 30% dividend which they are paying earlier, now they will keep. So 98,531 plus 2,468 is equal to 100,999. So what the company has decided? Previously the company was paying, the total net income is 8,226. Now again I am explaining. Total net income 8,226. Company was paying 2,468 dividend, retaining in the business 5,758. Now the company needs additional money. Additional money of how much? Additional money of 8,396 the company needs. So instead of borrowing this 8,396, now what the company has decided, whatever dividend we were paying 2,468, that also we will keep in the business. Then the total liability and equity side will be 100,999, and the new financing requirement will be, earlier new finance requirement is 8,396. Now you have created additional money 2,468, not paying dividend, use in the business. So another 2,468 there in the business. So additional money you need is 8,396 minus extra money you created inside 2,468. So the net money you need 5,928 to be borrowed from the market. Then the balance sheet will look like this. Accounts payable, debt as it is, total liability, stockholder equity. The stockholder equity will be 74,134 added with, see, 74,134. Write down in your calculator please. 74,134 plus whole the net income 8,226 is equal to 82,360. See here, 82,360. And the total liabilities is 100,999. And total assets are how much? Total assets are, so you remember this, total liability and equity is 100,999. What is the total asset side? The total asset side is 106,927. 106,927 is equal to 5,928 will be borrowed. You see here, 5,928 will be borrowed. This is the way the assets and liabilities are being matched. What we have done, either you completely borrow. If you completely borrow the money, the balance sheet will be matched like this. All the money of 8,226 required, you have 8,396 required, you borrowed from the market. So the debt will be 4,500 plus 8,396, 12,896, asset side equal to liability side. Now, instead of borrowing 8,396 from the market, whatever dividend you were paying, you stopped that. Then your borrowing reduced a little bit. How? Here we have explained. The company was paying dividend of 2468, that it has stopped. Then the extra money generated in the company 2468. Therefore, that much of money is reduced from the borrowing. Now the new borrowing is 5,928. This is the way we make the balance sheet match with each other. Say for example, you can do it at home. Instead of paying 30%, now the company decided to pay 0%. In the previous example, the company has paid zero dividend. All the 2,468 company has retained in the business. So the borrowing reduced to 5,928. Now you can make another change. Instead of reducing the dividend, the company wanted to increase the dividend. Now the company wants to pay 50%. Previously it was paying 30% of 8,226, the net income. Now the company wants to make 50% dividend payment. Then the borrowing will increase. How much? Make the calculation at home. Right? All clear? So this is the way we make the forecast target. And now before going to the 18.3, let me ask any question.